So now we're going to talk about a few more concepts, right? While you're assessing fair value, the price, right? At what level you need to assess the price. And there could be multiple other considerations, right? Which we will try and try and understand, right? On all these principles are extremely important for you to appreciate and understand. And we will also try and take few examples as we talk it through. The first concept is unit of account. So I think we've already talked about the definition. Then we talked about the restrictions. Now we're going to talk about the at what level I need to do fair value. Okay. And the fair value you need to do at a level at which, again, a transaction, you can exit out of that asset from a marketplace participant perspective. So if something is already quoted in the market, that becomes the fair value unit of account. If it is not quoted at that level, then into what? In a way, a group of assets. If you need to club them, then it is a group of assets. So at what level you will buy or sell, right? Those assets from a market participant perspective is what becomes a unit of account, right? So whether the asset or liability is a standalone asset or liability, a group of asset or a group of liability, or a group of assets and liabilities put together, right, depends upon its unit of account, The unit of account for the asset or liability shall be determined in accordance with the Ind AS that require or permits the fair value measurement, except as provided. This essentially defines the level of aggregation or disaggregation, right? Level of aggregation or disaggregation. So let's take this with the help of an example. A Limited has certain securities which are quoted at market. These securities are recognized at fair value in the balance sheet. In this case, the quoted price at individual unit, right? Individual share, because that is the level at which they are quoted, will be used to determine the fair value of the total number of shares which you have. Let's look at another example. B Limited has group of assets as per Ind AS 36, which is impairment of assets. To identify impairment on group of asset, I need to do this at a cash generating unit level, CGU, higher of fair value in use or in exchange, right? The recoverable amount, right? In use or in exchange. So fair value less cost to sell versus value in use, the recoverable amount, right? So then it says CGU is a group of asset or liability which has discrete financial information, which can generate independent cash flows, right? Therefore, the group of assets will be used in order to find fair value for the requirement of such standard, right? So that's how in a way you try and assess fair value in the context of A, the example one, which is at the lowest level, which is individual shares. In B, you try and do this at a group of asset, which is, let's say, permitted by another standard. So that's one important concept we talked about, unit of account, at what level. Another important concept is called principal market and most advantageous market. These are two concepts, okay? What is the principal market and what's the most advantageous market? And what does this mean? Why is this important? So what happens is that there are many products or many assets or liability you can sell in multiple markets, right? And the price which you receive is different in each of the markets, right? So you may receive price X in market A versus price B in market Y. A very simple example of let's say we have two stock exchange, NSE and BSE. And if you are a very shrewd investor, right, you want to look at what price it is trading in NSE versus what price it's trading in BSE. And then, okay, you want to sell and this is the higher price, or you want to buy here, it is trading lower. And there could be those arbitrage opportunities, right? So I think essentially you need to figure out that what is the principal market and what's the most advantageous market. That's the concept we're trying to learn. And it's a very important concept because a couple of examinations questions which we saw are actually based on this concept. So the principal market is a market where I have access to and I have the ability to transact in that market, and that market has the highest volume of activity for that type of asset. All right. So that is what is called principal market. Now let's look at a scenario where there is no principal market. So I should always use principal market to determine fair value or to determine exit price from that perspective. Now let's assume a scenario where there is no principal market. Remember, no principal market. There are multiple markets where I can transact, and it is given in the fact pattern that there is no principal market. Then I need to look at the most advantageous market. Now, most advantageous market by definition means where I can maximize the value. Okay, where I can maximize my value. That is what is called most advantageous market. But remember, if the principal market exists and there is an advantageous market, then advantageous market is not relevant. I have to go by the value which is there in the principal market. Okay, so these are two concepts, principal market and most advantageous market. If the principal market exists, then advantageous market is not relevant. And if the principal market does not exist, then I need to determine the most advantageous market where I maximize the value. And how do I determine that what is the fair value? Fair value is the value, the quoted price, or the price at which I can exit, right? A price which is received to sell an asset or transfer a liability in an orderly transaction between marketplace participant at the measurement date, right? So that's the fair value minus the transport cost, not the transaction cost, minus the transport cost. Okay, so if there is a transportation cost, so let's say if I were to sell something next door, the transportation cost is 10 rupees. If I were to sell something next town, the transportation cost may be 100, right? So my realization in a way then goes down. Okay, so fair value minus the transport cost, that becomes the is the benchmark for fair value. And we will try and understand this with the help of example. Okay, so what's the principal market? Market which is normally the place in which the asset or liabilities are being transacted with highest volume, with high level of activities, comparing with any other market available for similar transaction. Example, P Limited is an automobile listed company. Its shares are listed on BSE and NSE. At year end, the closing share price of P Limited in both stock exchanges are different. Okay. Generally, the price at NSE has greatest volume and activity, whereas at BSE, it is less in terms of volume transacted in the period. However, the closing price in BSE is higher than the price in NSE. Since NSE has got highest volume and significant level of activity comparing to other market, even though the closing price is higher in BSE, the closing price of NSE would be taken as principal market, market with the greatest volume and the level of activity where I have access to transact. That is the market that is a principal market from the perspective of that asset or liability, or from the perspective of that company. Now, what's the most advantageous market? Absent a principal market. If there is no principal market, market that maximize amount that would be received after transaction and transportation cost. Example, gold has got a domestic market and an export market. The prices at domestic markets are lesser comparing to the price available for export of similar gold. As a policy, the government has capped the export of gold at maximum up to 20% of total output by any manufacturer. The normal trading activity of gold are being done at domestic market only. 80% you do domestic, 20% because there is a cap. In this case, the highest level of activities are happening in the domestic market, so they become the principal market. Okay. Now, export prices are more than the price in the principal market, but they are not relevant from the perspective of assessing fair value. Okay. However, then the export market can be considered as most advantageous market. So if you don't have a principal market, then this is in a way relevant. However, if principal market is available, then its prices would be used for fair valuation of assets and liabilities. Okay. What's the market participant? So we said we're going to talk about multiple things coming out of the definition of fair value, right? So what is the meaning of a market participant, right? An entity shall, what's the market participant? Means that I as a market participant or a buyer or a seller of that security or that asset or that liability, I have full knowledge about that asset or liability. And if I'm a related party, again, that is at arm's length, all right? An entity shall measure the fair value of an asset or liability using the assumption that market participant would use when pricing the asset or liability, assuming that market participants, okay, act in their economic best interest. They are not influenced by others, okay? They're acting in their economic best interest. So what are market participants? Parties which eventually transact the asset or liability either in the principal market or in the most advantageous market. They should be independent, not a related party. However, if related parties have done similar transaction on arm's length price, then it can be between related parties as well. The parties should not be under any stress or forced to enter into those transactions. All parties should have reasonable and sufficient information about the same. That is what is a market participant. Okay, so we talked about market participants, we talked about principal market and most advantageous market, we talked about unit of account, we talked about entity specific restriction or a security specific restriction, right? And of course we talked about the definition. So the number of things is what we've talked about at a principal level with some examples, right? Let's try and understand this market participant business or the restriction with the help of an example. So X Limited has a land with legal restriction to use it for commercial purpose for next 20 years, all right? The restriction on the usage of land is irrespective of its holder, okay? That means what? It's an asset specific restriction. The fair value of the land will include this restriction because it is an asset related restriction, and any buyer will need to take over with similar restriction to use the land for next 20 years. Now, to evaluate its fair value, one has to consider the restriction based on the assumption, which normally would be taken into account by the market participant mentioned as below, right? Market participants, which are independent, we have knowledge, and they are not related, and they have the ability to do the transaction, right? Whether the restriction is commonly imposed, how useful it will be after the end of 20 years, whether there is any alternative use, how liquid the sale of land will be, comparing the prices with similar kind of land. So you look at multiple factors to, in a way, determine fair value of such land. All right. So what is fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction, right? In the principal or most advantageous market at the measurement date under current market conditions, right? Regardless of whether that price is directly observable or estimated using another valuation technique. A fair value is being assessed based on principal market, and if principal market is not available, then based on most advantageous market. Okay, then based on most advantageous market, right, is not available, then only you go to most advantageous market. And a number of things which we've been talking, right? We talked about restrictions. We talked about unit of account. We talked about principal market. We talked about most advantageous market. Right? We talked about market participant itself. Right? And then we talked about market participant. Okay, and then we talked about exit price. Okay, the number of things we've been talking, just we will make sure that you understand all of these concepts. And also we talked about orderly transaction. That means active market. Okay, active markets. All right. So let's just try and understand the distinction between transaction and transport cost. Okay, so transaction cost is to be considered in determining the most advantageous market, but they are not to be considered while doing fair value, while determining fair value. Okay, so principal market is where significant level of transaction and activities takes place, and it eventually consider all such transaction cost. Hence, would not be appropriate to consider any transaction cost further while assessing fair value from such principal markets. Transaction costs do not include transport cost. Now, transport cost, if location is a characteristics of the asset, as might be the case, for example, for a commodity, the price in the principal or most advantageous market shall be adjusted for the cost, if any, that would be incurred to transport the asset from its current location to that market. It would be considered if in case it is an inherent part of the asset or liability so transacted. For example, commodity. Okay. So if the principal market is available, transaction cost no, transportation cost yes. If the principal market is not available, then calculation of net realizable value, I need to calculate. I will consider the transaction cost and the transportation cost. For calculating the fair value, okay, I will not consider the transaction cost. I will only consider the transport cost. This is a very, very important principle. Please focus on this, understand this, remember this, okay? Remember this. If a principal market, transaction cost is not considered, transport cost is considered. Now, if you don't have a principal market, to determine the most advantageous market, I'm going to consider the transaction cost and transportation cost. However, for computing the fair value, I will not consider the transaction cost. I will only consider transportation cost. All right. So that is what the principles are. Please focus on and remember. This is a very, because next two questions which I want to see, which was there in your examination, has come from only on this principle. All right. Star Limited sells raw material which is actively traded in market X. Also, the market is considered to be a principal market, being significant volume of transaction and activities for the raw material. However, fair value of the raw material is required to be assessed for market Y. Fair value of the raw material is required to be assessed, okay, for market Y, which is far from market X and require a transportation cost of INR 500. The transportation cost is not a transaction cost and it is not specific to any transaction, but inherent cost. Hence, it will be considered while evaluating fair value from the principal market, okay, from market X to market Y. All right. Awesome. So let's look at the example which was there in November 2019. An asset is sold in two different active markets at different prices. Menor Limited enters into transaction in both markets and can access the price in those markets for the asset at the measurement date. In Mumbai market, the price that would be received is INR 290. Transaction cost in that market is INR 40. The transaction cost is INR 40 and the transport the asset is INR 30. Thus, the net amount would be 220, which is nothing but 290 minus 40 minus 30, right? So I'm getting 220, okay? In Kolkata, the market, the price would be received to sell is 280, okay? Transaction cost is 20 and the transport cost is 30. Thus, the net amount that would be received is 230, right? Which is 280 minus 20 minus 30. Question is, what should be the fair value of the asset if Mumbai is the principal market? What should be the fair value if none of the market is principal market? If the net realization after expenses is more in export market, say INR 280, but government allows only 15% of the production to be exported out of India, discuss what would be the fair value in such cases, right? So, if Mumbai is the principal market, what should be the fair value, right? The fair value will be 290 minus 30, which is the transport cost, which is 260, okay? Now, if none of the market is a principal market, then I need to determine the most advantageous market. And then my realization in Mumbai is 220, whereas here it is 230. For the purpose of determining the most advantageous market, I'm going to consider both the transaction cost and the transport cost. Okay, and when I do that, then I realize that Kolkata is the most advantageous market because my net realization is 230 in Kolkata. But what is the fair value for doing Calcutta? I'm now for determining fair value in Calcutta, I'm going to take 280 minus 30, which is the transportation cost, which is 250. Okay, so 250 is the fair value. Even though Kolkata is most advantageous, my fair value for Kolkata is 250, whereas my fair value for Mumbai is 260, okay, because of the transaction cost, which is not to be considered while recording the fair value, determining the fair value, right, from a recording perspective. Okay, now the second element of the question is, if the net realization after expenses is more in export market, which is only 15% is permitted, can I consider that? The answer is no, because 85% of your transaction are going to be in domestic market. So you got to consider that. That's the principal market. And if there is a principal market which exists, then you need to first take the principal market valuation. If the principal market do not exist, then only you go to the most advantageous market. All right, so let's go through the solution. Principal market, which is normally the place in which asset or liabilities are being transacted with highest volume, with high level of activity comparing with any other market. Most advantageous market that maximize amount that would be received after transaction and transport. Again, while you're trying to draft the answer, you should also try and explain the principles. Okay, just don't jump onto the answer. So if the Mumbai market is the principal market, then Mumbai is the principal market, the fair value of the asset would be measured using the price that would be received to sell an asset, right, after taking into account the transportation cost, which is how much fair value will be. Price receivable 290 minus 30, which is 260. Okay, which is 260. Transaction cost is not to be considered for calculation of fair value. Now, if neither of the market is the principal market, okay, then I'm going to look at the most advantageous market. Okay, now for calculation of the most advantageous market, I'm going to compare with both, right? I'm going to look at the realizable value with my transaction cost and the transportation cost. Okay, and that number for Mumbai is 220 and Kolkata is 230. So Kolkata is most advantageous market. Okay, now for recording the data fair value, right, since none of the market is the principal market, entity should measure fair value using the price in the most advantageous market, that is one that maximize the amount that would be received after taking into consideration both the transaction and the transport cost. Hence Calcutta is most advantageous, as our proceeds are here INR 230 in more than the Mumbai market. All right, now however, the fair value of an asset in such a case would be, right, my price realization less the transportation cost, which is 250. Okay, 250. Okay, now the last leg of the question. Now, if there is an export, right, where I make 15% and this is given higher return, the export market again would be considered as most advantageous market. Okay, however, since the government has capped the export maximum up to 15%, maximum sale activities are being done at domestic market only, which is 85%, right? Therefore, the prices received in domestic market would be used for fair valuation of asset, as they are the principal market. Domestic market is the principal market, and if there is a principal market, then the advantageous market relevance goes away. All right, then I'm going to focus only on the principal market. Awesome. I'm now going to look at another case study, and surprise, this was verbatim of what was there in the previous example, which was adapted from November 2018, but this was only for 5 marks. So an asset is sold in two different active market at different prices. An entity enters into transaction in both markets and can access the price in those market for the asset at the measurement date. In market A, the price that will be received is INR 78, the transaction cost is INR 9, and cost to transport is INR 6. In market B, it is 75, transaction cost is 3, and the transportation cost is 6. Now you are required to calculate the fair value of the asset. If market A is the principal market, fair value of the asset. If none of the market is a principal market, the export thing goes away here, right? So simply calculate the fair value. So it's very simple, right? If A is the principal market, then simply the fair value is 78 minus 6, which is 78 minus 6, which is 72. Now then it says, if none of the market is principal market, then I'm going to look at my net realization. 78 minus 9 and 6, which is 15. And that gives me 63 from market A, right? And from market B, I get 75 minus 9. Then I get how much? 66, okay? That means market B is most advantageous market, right? And then I need to determine the fair value, which is 75 minus the transport cost, and the transport cost in B is 6, right? And that means my fair value, okay, will be how much? 69. Okay, my fair value will be 69, the most advantageous market. The fair value is 69, and if A is the principal market, then I'm going to record fair value at 72. That's what broadly the answer is. But again, remember to write the principles. Okay, principal market is market which is normally the place in which the asset liabilities are being transacted with highest volume and high level of activities. Most advantageous, where you maximize the benefits. If market A is the principal market, the fair value of the asset will be measured using the price that would be received in the market after taking into transportation cost. Fair value will be price receivable 78 minus 6, which is 72, right? Transaction cost is not to be considered. If let's say none of the market is a principal market, then I need to determine the most advantageous market, and to determine the most advantageous market, I need to reduce the transaction cost and the transport cost, right? I need to reduce both the transaction cost and transport cost. Okay. And I again do this table, transaction cost and transport cost. It is 63 and 66. And this guy is the most advantageous market, which is market B. But for me to record or determine the fair value, I'm going to ignore the transaction cost, and then I'm going to only consider this, which is 69, right? So how much is my fair value? If I were to ignore the transaction cost, none of the market is principal market, entity would measure fair value using the most advantageous market, and the market B is the most advantageous, and the fair value is 69. I hope all of this makes sense to you, right? Number of principles we've been talking about, right? Let's try and quickly summarize what all we've talked about. We talked about the unit of account. Unit of account is the level at which you're going to measure the asset, the level at which you're going to transact with the asset in a way from that perspective. That is what is called a unit of account. Okay, and if it is ordinarily, if it is quoted, then that is the unit of account. If it is unquoted, then you again look for reference in the standard, like we talked about the guidance under Ind AS 36, where you look at a CGU level, right? We talked about the principal and the most advantageous market, right? The principal market, the greatest amount of activity, and I have access to that, that level of transaction. All of that is what is the principal market. If there is no principal market, then you need to assess the most advantageous market. And for the purpose of assessing the most advantageous market, where you maximize your value, to determine how do I maximize my value, you look at the sale price and the transaction cost and the transport cost. All of that is what you consider, and then you assess, look, this market is the most advantageous market, and then you determine the fair value while only considering the transportation cost. You don't consider transaction cost while recording fair value. But for determining the most advantageous market, you will consider both transaction and transport cost. We also talked about the market participant. Market participant means the person who has knowledge about the asset, person who has the ability to do the transaction, person who is not a related party or an independent party. And if it's a related party, they should have the ability to do the transaction at an arm's length. So all of that, person who is doing the transaction not under duress, right? So they are active, they are capable of doing the transaction, right? We talked about the active and inactive market. Active, where there is enough activity happening in the market in terms of buying and selling, right? And it could be, there could be a drop in volume. That doesn't make it inactive, right? Active is that there is an orderly discovery of in a way the fair value, right? And certainly if there is a huge spread between the buying and selling value, and that is where your antennas should be up to say that is it an active or an inactive market. We talked about the exit and entry price. It is actually exit price while you determine your fair value. Fair value is nothing but the exit price, price which is received to sell an asset, or price which is paid to transfer an liability, right? In an orderly transaction between marketplace participant at a measurement date, right? And we talked about the transaction and the transportation cost. All of these things is what we talked about at length. We talked about the unit of account, which is essentially defines the level of aggregation or disaggregation while calculating fair value. We looked at the transaction cost, is the assume that the asset or liability is exchanged in an orderly transaction between marketplace participant, right? And then we looked at the principal market with the greatest volume and the amount of activity, right? And the most advantageous market is nothing but where you maximize your value after considering both the transaction and the transportation cost, right? After taking into account the transaction cost and the transportation cost. Okay.